or children who are in a totally different time. You get it. Those days your mother would just give you an eye and you know this is a problem.
Hey, there are visitors.
And it's just there are visitors
and
around.
Mom gives you this eye, you know?
Yes.
Catch more of this every Monday to Friday at 9 p.m.
A very good evening to you, our esteemed viewer. We want to thank God for today. We want to thank God for you. We want to thank God for the life He has given us. Of course, we thank God for the victory that you have attained. You who is celebrating, we celebrate with you. And you who is mourning, all we can say is that may God comfort you and strengthen you and take you through the situation that you are going through. However, here we are with Family Hour, empowering families one episode at a time, and this is our Wednesday edition where we talk about finances. And of course, we know that this is a month of June, and so that is the month that where the word tax tax compliance, tax filing come up most commonly. Although we know that at different stages you're supposed to file returns, but I think it becomes more sounding in June. That is when URA sends alerts to people to at least make sure that they file their returns before 30th of June, and the countdown is on. However, we are here to to broaden our understanding of taxes. Last week there is something that came up, and that was income tax. And so today our conversation is going to rotate around income tax, and of course our guest is Dedan. It's a pleasure having you.
Thank you. Thank you. I'm happy to be back.
And good evening.
Good evening to you.
Kindly greet our viewer, and we shall get into our discussion.
Thank you. Good evening all. I hope you will enjoy this. I also greet my family out there. I know they are watching how daddy, how the husband is actually making the world understand tax, and specifically income tax.
Okay. Yeah, we are glad that we are talking about this. Is something that came up after the show last time, and we thought that it is important that we come back and talk about this, because this is the reason we have this program and this platform to at least help people get to the real understanding of things that they have doubt in. And the concern was, you told us that the first thing you do is to get a TIN number.
Yes.
And when you get a TIN number, the first tax that URA expects from you is income tax.
True.
And someone was concerned that how does income tax now differ from pay as you earn? Because if I get my TIN number, and because maybe my boss has requested for it, and then how do I get to income tax, yet I have to pay as you earn as well? So we start from there.
Oh, thank you. Thank you. That's a good question. To start with, both pay as you earn and the so common called income tax are all called direct taxes, because they are levied or charged on someone's income. The difference lies on how it is administered and how it is collected. That for pay as you earn, because I'm employed by Family TV, my taxes to URA are charged on my monthly pay before I actually earn. That before I'm paid, it is the obligation of Family TV as my employer to actually deduct what belongs to the government, and it is paid. So it is now the obligation of my employer to pay. But what he pays, or what the entity pays, is what has been deducted off my monthly earnings. That's now for income tax. That you as Mukalazi, if you are employed, it is not your obligation to run and pay to URA. You don't need to file a return. No. It is the role of the one who employs you who is required to deduct and pay to the government. Important that as long as you are employed, the government earns off your salary before you earn. Because you don't have the luxury of first earning, planning on how to spend, then you pay the government.
That is for income tax.
that is specifically pay as you earn.
Okay, pay as you earn.
Yes, that we call it. We say it is deducted at source. Before you are paid, you who has worked, before you are paid, the government first takes its share, and this is done
of my
by
efforts.
Yes, this is done by your employer. Now, different from now what we call income tax. It is now, this is for people who are in business. That people who are in business, if for example I wake up and I start a demo consult, the income tax to be paid, I will first look at how much have I earned in a period, how much are my expenses, then what remains is where the tax rate is applied. So the first difference is that for income taxes, for people in business, you pay a tax after spending. But for pay as you earn, you pay the tax before
earning,
before spending. You work for a month, that means you have earned, you qualify for this payment.
Yes.
But before the payment comes to you, they first deduct what belongs to the government.
That is pay as you earn.
Yes, you earn, pay a tax, then now
You
receive.
spend. You receive and
what
spend. Okay.
But when I'm in a business, using an example of demo consult, I will earn my incomes, spend, but when I'm spending, as we shall see, I will spend on those expenses that are allowed by the law, not just spending on anything. Yes, those are the details we shall see. That when we are preparing for filing, you look at what are these expenses that the tax law allows you
to spend.
Yes. So they are what we call allowable expenses, that according to the tax law, these ones are business expenses. There is also what we call non-allowable expenses, that these ones, if you spend on them, they are not allowed as far as the tax law is concerned. What am I saying? That, for example, if I pick money from demo consult and I buy my wife a gomos, a gomos is good, I've gifted her, but that is not a business expense. Yes, if I get money and pay for my children's school fees, I'm picking money from the company. Remember what I said last week, that a company and dividend are two different entities.
Yeah.
So if I'm to pick money from the company, it must be through a dividend. So if I just wake up and pick money anyhow, that money can never be an expense. An expense, for tax purposes, this is money you spend while earning or in trying to earn an income. For example, I have staff. So the salaries I pay to my staff constitute part of allowable expenses, because these are the people who actually make money. I pay rent. This is where we sit. Maybe I pay for water, I pay for other utilities, all of these I buy stationery. These are what we call allowable expenses. So I will get my incomes, I subtract the expenses that the tax law allows. Then what remains, the government is waiting for 30%.
Of what remains?
Of what remains. There would be profit in our layman language. But now, if it happens that after subtracting all these allowable expenses, I'm in loss position, then I do not need to pay any tax. Very important to note. Quite often people say, me, I will not file returns because I'm not yet making profits.
Yeah.
The issue is not profits. The issue is, one, communicate your position to the government. But in case you have made a loss, this loss, you can actually carry it forward as an expense. That in another year, following the one where you have made a loss, you can still use this loss to reduce your tax liability. So, in simple terms, that's the difference between income tax and pay as you earn. They are all direct taxes charged on entities' incomes or taxable persons' incomes. But the difference is pay as you earn and pay a tax, then receive.
So, in other words, the difference is that for income tax, you should be in business. And for pay as you earn, you should be employed.
Formally employed.
Formally employed.
Yes.
Oh, now I think that becomes more clearer. So the worries, I think reduced now because someone was already. You know, when you talk about taxes, and each time you talk about a tax, when it's not clearly explained, someone will come out and say, "So I have to pay even this tax," and so it looks like a burden. But now, still talking about income tax, and you have talked. So, is it also something I'm supposed to file at the end? For example, at the before 30th June, is it also something I'm supposed? Oh, income tax has a different provision.
Now, for income tax, you are meant to file both provisional returns and the final returns, but these are filed at different intervals.
Okay.
As a matter of fact, for example, a company, you file 2 provisional returns. That once a financial year has started, normally when in these discussions we follow the normal year, and the normal year is the July to June. That's the normal government financial year. So a business that follows that period files 2 provisional returns. That is one which is for the first half of the year. So that is by 31st December. At the end of the 6th month, you are meant to file your first provisional return. Then at the end of the 12th month, you are again meant to file your provisional return, which in this case is the final. Why do I call it a final? That you realize that you can file a provisional return on 1st July because you have from 1st July to December. And you also have from now 1st Jan to June. That makes 12 months. Within the 12 months, you can amend your provisional return as many times as possible because this is an estimate. This is an estimate. But the one for June, by 30th, the one that you file last as a provisional return, has a condition that it should be 90% close to your final return. Now, the moment a financial year is closed, then you have other 6 months upon which you should file what we call a final income tax return. But for this, because you have looked at the results from your operations, you have prepared your financial statements, you have everything, so it should be a natural return that once, even if they come for an audit, then they can verify whatever you have submitted. But importantly, you see, in an era where we are, a subject called tax planning has become inevitable. It is one of the strategic cornerstones of treasury management or of any business, that a tax takes a big percentage of the income made by a business. How? I told you last week that when you make a profit, 30% is charged as income tax. If you are a business owner and you want to take money from the business, again you are charged 15% through what we call withholding tax. So in total, that becomes 45%. So it would be living in denial, and it would be self-defeating to plan for capital, and you plan for staff and all these other things, and you forget an expense or a cost that consumes your 45% of the money made. So businesses today, you must plan for this thing called the tax. And the starting bit of tax planning is understanding tax laws.
Okay.
Because here you are saying, how can I work within the tax laws? How can I structure my business? How can I analyze my transactions so that I minimize the tax liability? Very key. You are looking for ways how to structure your transactions. You analyze your transactions so that at the end of it all, you minimize your tax liability. Now, when you talk about a tax liability, it's also important to appreciate what constitutes a tax liability. One, we talked about, for example, the 30%. That is part of the tax liability. In case you have made you have defaulted on any legal provision, any tax legal provision, there is also what you call a penalty. A penalty also is added onto your principal tax. In case you have delayed, there is also what you call interest that is charged. On income tax, for example, they charge interest when you delay to pay. So what am I saying? That by the time you look at minimizing tax liability, you are looking at how do I minimize the principal itself, how do I minimize the penalties, how do I minimize the interest, the three things. And now this is how you can actually minimize this tax liability. That the starting point is understand the law so that you know what the law requires from you. Excuse me. What the law requires from you and at what point. Then, after understanding the law, you must maintain records, as we stated, because if you are to analyze your financial transaction, they must be recorded. If they are not recorded, then what you are doing is not actually tax planning, because you will be planning without a basis. You get my point? Now, a number of ways how you can actually structure or how you can minimize your tax liability. That one, you need to do right things at the right time. How does this help? That if I'm meant to file a return by 31st December, I file it. Because if I don't file it, I will be penalized for not filing it. I said again last time that, for example, income tax, if the deadline is December and December you have failed to file, every other month that you are late, the taxman is penalizing you with 200,000. So one of the ways to avoid the penalties, do the right thing at the right time. The same applies to interests. You are being charged interest because you have delayed to pay. So pay on time so that you avoid
the interest.
Importantly, now we looked at the principal tax. For the principal tax, we look at now we start with what we call allowable deductions. You look at these expenses that the tax law, the taxman allows as expenses, as business expenses, then maximize.
So is the allowable and non-allowable expenses also included in the tax laws? That when you read about the tax laws, you can get, and I think the other concern would be, I look at a man downtown here who has saved their money and they have opened up this business. They have no knowledge about tax laws and because when you talk about laws, someone will think about now getting a lawyer or constitution, what. So where do they get the tax laws? Where are they?
Thank you. You realize that in economics, when I was still in class, there is what we call specialization.
Yes.
When you wake up and start a business and you have your capital, your core is to do business. Me who went to school, I did BCom, I did SCCA, I did CPA, I did CTA. All of these, I've also made an investment in myself so that I understand these things that I'm talking about. So you who is in business, look for a tax consultant who will help you understand these laws, but also help you do what you cannot do. That as you focus on running your business affairs so that you make a profit, then the tax person or the tax consultant helps you to minimize the tax liability so that whatever that you have made is not washed away or it is not taken by the taxman. Because the tax consultant will work within the laws. Because the taxman or a tax consultant knows what is allowed and what is not allowed. I will give a few examples of this. That one, when you are to invest, look for sectors that are being favored by the government, because there are sectors, for example, where incomes are exempted. I will give an example that if you are in Uganda and you are a citizen of Uganda and you are in manufacturing and you start a business to produce for export, you have 10 years of not paying income tax. But many of us, we don't know about that. We are actually saying the exemptions are being given by foreigners.
Yes, foreign investors.
No, it is not actually true. I can confidently tell you that the law says that if you are operating in an industrial park, if you are investing in an industrial park, for example, whereas it requires a foreigner to have a capital of 50 million to have an exemption of 10 million, an exemption of 10 years without paying any tax. For a Ugandan, it is only 10 million. You get the difference? That they are saying, Uganda, as long as you have an investment capital of 10 million USD, you are investing or you are starting up business in an industrial park or a free zone, then you will spend 10 years when you are earning and not paying any tax. But if you are not a Ugandan, for you capital should be 50 million.
USD. We are taking a short break. When we come back, we are going to start from there. Now, this has been a compliment. I think now we know what exactly and how it comes about. We are coming back shortly. Welcome back from that commercial break. We are looking at tax compliance, and now before the break there is something that came, and this has been this has been a voice that we have always had, that the foreign investors are given a tax exemption of 10 years, and then the local investors don't benefit from this. And of course, we've seen how it comes about. But also, are there any other exemptions that come by tax exemptions?
Yeah, they are actually many.
Okay.
As I had stated, we need to appreciate that when we talk about tax planning, we are looking at three things in one. That one, do the right thing at the right time. Two, maximize the deductions. And I wanted to first say something before I go to exemptions and other reliefs. I wanted to emphasize one point on maximizing deductions. That, for example, if I have employees, I've already paid them. Why can't I pay as you earn for them so that I can claim an expense called salary? Most of the businesses you look at around, actually their biggest expense is on salaries. But you pay salaries, but again you feel you want to under-declare your salaries. Then I always ask these people, if you under-declare your salaries, where will you benefit from? Because a business can only benefit from paying salaries if these salaries can help the business reduce the tax liability. That's the essence of saying maximize the deductions, because these deductions are provided for within the law. So make sure you maximize them. The other important point I want to make, for the last 2 to 3 years, there has been an issue to deal with loans. Because loans, under normal circumstances, when you borrow a loan, then you are paying interest.
Yeah.
So interest is an expense. So if you have a loan, make sure it is properly documented so that you claim these interests as expenses. But some people have loans one side, but they don't have any document to support
them.
So if you cannot support your loans, then the taxman will not allow an expense called interest. Hope that one is also clear. Now, there are many other...
So that means that the way I perceive it, the more you include allowable deductions, is the more your tax goes down.
Exactly.
Okay.
That I have already incurred these expenses and they are allowable. So why should I suffocate them or suppress them? So I must declare them maximum, so that my liability is low. And in a minute, there are many allowable deductions that, for example, if you have a bad debt, a bad debt is when you are selling on credit and someone has not paid you. It can actually be allowed as an expense as long as, one, this bad debt has been it has been in your records. When you sell, it means you recognize an income. So, but you are saying this income that I recognized, I'm unable to collect it. But also you have taken the necessary steps to ensure that you collect. So that one is allowed as yes,
allowable deduction.
An allowable deduction. I talked about losses. There are others. If, for example, you are giving your staff meals at your workplace, these staff meals should be on equal terms. Nothing like give Mukalazi 100,000 for food, give Didan 20,000 for food. No, you have physical food that is actually served at your workplace. That will also be allowed as a deduction. Now, relatedly, I have seen a situation where employers give allowances. You are given 200, that is for your transport going home, and that is on the side of the employee. It is a taxable benefit. Yes. Why? The law provides that the transport from home to work, it is of a domestic nature. And for that matter, it is not a business expense. So if you are given that money, then it should be included in your pay as you earn computation. That's the only way your employer can claim it as an expense. If not, then the taxman will not allow it as
an expense.
So in short, all expenses that are spent while trying to earn an income should be included so that you minimize your tax liability. Also, is what you call capital expenses. You have bought this furniture, you have bought all of these equipments. So, how do you benefit from them? The law gives you a deduction that you will make every year as an expense. That a certain percentage will be reduced from your incomes to offset, to reduce your liability. Now, one tip for tax planning purposes, there is what you call the timing of buying these assets. For example, that if I buy motor vehicles, let's say trucks, in June, at the end of the financial year, I can actually claim a deduction for the entire 12 months. I don't know if that one is clear.
Repeat it.
Motor vehicles or trucks, if I use specifically trucks, they form part of the assets that are given what we call depreciation that is allowed by the taxman, what we call capital allowance. But the timing will create a difference. That one who buys a motor vehicle in July will use this motor vehicle or this truck for 12 months. So by the time you claim this benefit, indeed your motor vehicle or your truck has been working for you, so wear and tear has taken place. But the one who buys at the end of the financial year will claim an expense as if this trucks have been used for the entire year. That's the bit of tax planning that we are talking about. You get my point?
Yes.
That for you, you buy, use it for 1 week, but claim an expense for the entire
Yeah.
year. Hope you get my point.
Yes. Yes.
Now, the other important point is taking advantage of reliefs, exemptions, and tax holidays. The way I had given an example of if you invest, if you are an investor in an industrial park, how you are given, and you are producing for export, you are given 10 years, your income is not taxable. Now, there are others. For example, in the new tax amendments that are taking effect from 1st July, Ugandans who are starting businesses up to capital of 500 million have been given a chance to operate for 3 years without paying any income tax. That's a new development. However, many people are excited about it. I hear it's as if some people take it like it is for everyone. No. The first condition is you are starting a new business, but also you are compliant. You are able to file your returns and you get. Not just starting to hide and then after 3 years you run away. No. This relief is conditioned. The other one, as part of reliefs that we have seen over time, now there is this other one, that because people have a lot of penalties and a lot of interest on their tax ledger, the government has said that from 1st July, if you pay the principal, remember I talked about the principal tax, the penalties and the interest. If you are able to pay the principal tax being demanded between 1st July 2025 to 30th June 2026, those are 12 months, that if you are able to pay your principal tax outstanding or penalties and interest that were outstanding by 30th June 2025, they will be waived off. It is something that people can take advantage of, because you find someone is having 20 million on the ledger, but out of 20 million, interest and penalties amounts 12. So the implication is that if you pay the 8 million within the 12 months, then the 12 million will be waived off. You will not pay. It is a relief that the government has given us as Ugandans. That is something I think people in business must really take advantage of and clean their ledgers.
Okay.
Yes.
Okay. There is an expense that some people take advantage of. For example, we have people who work for commission. They are not paid salary. They worked for commission. I mean, they're given commission. So, for example, you bring in business, they give you your commission of a particular percentage. Is this an allowable deduction?
Thank you very much. It is a very, very good question. I don't know why I had forgotten about commissions. Remember, the time given to us, we cannot list all of these deductions and exhaust them, but that one is an important one. How? That you go to someone's financials or financial transactions, you find commissions are only amounting to 300 million. And this person feels he will submit to government or to URA and they allow. The government will not allow an expense called commission unless, if you want, as again a tax planning tip, if you are paying any commission to anyone, at minimum deduct withholding tax of 6%.
Of the commission.
Yes. Now, for you as a business person, you are protecting yourself. I paid someone and I even withheld from this person. I did my part. So whether this person declares or not, that is not your business. But for you, at the point of paying commission, make sure you deduct 6% so that you are safe. Now, it is common now with people who deal even with government people. So you are giving a commission, but this person does not want to be declared anywhere. At minimum, at least deduct 6% so that the tax, you first pay the 6% to the taxman, then the other explanation will follow. Short of that, expense called commission is not allowed. Yes.
And it is common downtown.
Very
here.
common.
Someone brings a client and then you're supposed to give them a particular percentage.
Actually, downtown it is okay because their transactions are not as serious as these big contracts in the government. Yes, the commissions in the government, upper town, there is so much to deal with commissions than downtown. Because I mean, how much is involved? You bring someone who is buying things of 2 million, how much is that commission? That one, even if the government does not care about it. The issue is with these big contracts. A commission of say 5% of, let's say, 10 billion, how much is it?
It's quite a lot.
Yes, so the taxman is not willing to listen to an expense called the commission. The other important thing that people must adhere to, when you are paying someone, the professionals, paying a lawyer, paying an auditor, you are paying marketing people, URA has a category called professionals. If you are to claim anything to deal with professional fees, ensure that you have withheld 6%. Yes, because a lawyer will come, bills you, let's say 20 million, you pay. You put it in your returns, the lawyer goes. But after 2 years, URA comes to you and says, oh, you paid professional fees. How come you didn't withhold 6%? There are two ways URA can handle. One, they can disallow that expense. Disallowing means they say this is not an expense. If they say this is not an expense, then they will charge it 30%. It will mean it is your profit. So they will charge it 30%. On a number of occasions, URA is lenient. And the law also supports URA that if I was meant to withhold from you, and I pay you without withholding from you, then URA will charge me. So that's what URA is doing, that if you pay a lawyer and he has gone and you have not deducted or withheld from the person, at one point URA will charge you that 6% you yourself. That's a linear, that's a way of saying they are fair. But under normal circumstances, they will disallow that expense and charge you 30%. Yes.
So taxes are serious. But now let us talk about provisions of tax filing.
Now, it is good you are asking about provisions. I want to first tell our people out there that the deadline for filing provisional returns for those who operate under a normal financial year, which is July to June, the deadline is 30th June. But as I had stated, that you start with the first one, which is by December 31st. But now the one I'm insisting on is the last one. As I said, you can amend several times. But now we are saying that the last day of the financial year, which is 30th June, make sure you have filed. What do you need to look at the point when you are filing? You need to ensure that this return filed is 90% close to the final one, to avoid being penalized for under declaration. That the moment what you file by 30th June is not equal to 90% of your final return that you file in December, then expect URA to penalize you by, I mean, when you file the other return, the final one, the system, actually, it's the system that computes straight away and charges you under declaration penalty. What do you need to do to avoid this?
Yes.
That one, this provisional return, you file it at a point when you have operated for full 12 months. So you are sure of the results from your operations. Starting point is that reconcile your records. What do you have in IFRS as one source of reports? What do you have in your withholding tax reports? What do you have in your system, internal system? So that you are sure that all incomes that I made have been put together so that you declare them. Which expenses do I have? Because if you understate, I mean, if you understate your expenses, maybe there are expenses that were incurred, and by 30th June, you haven't recognized them. Then you will possibly not take care of this. What does that mean? That you will assume a figure that is not actual. When you reach at the point of now preparing your income statements and balance sheet, then you find the situation is actually different. Now, that will lead you now to a penalty of 20% of the difference between what you declared and what would have been the 90%. 20% is the penalty. So I'm actually telling our people there in business that right away, the period that we are in, you should be now doing oral reconciliations, get your bank statements, analyze them. If you can't, at least have a tax consultant. Maybe what I didn't mention is that, one, we have what we call Uganda Tax Agents Association, and I'm a member. One of the things that we do is that at one point we even give what we call probono services. That if you feel you're a business struggling, you don't have money, some of these services, we can actually give them to you free of charge. Instead of struggling with these issues, come to us. We are in a way guide. That's the only way we can also give back. We can also support these businesses to grow than just keeping quiet, and you find the taxman is crossing you, the taxman is running after you. When you talk about URA, it's as if someone has made, no, URA, they are doing their mandate. They are tax collectors. If you feel they are not doing it, just ask your MPs, because they are the people who actually formulate these rules. So that's what I can say on provisional returns, reconciliations, so that by the time you put in your return, it is 90% accurate.
Okay.
Yes.
I look at a situation, lastly as we wind up, where, for example, I've gone to the village on Christmas, I've sold a few things, I've come with my capital, I've opened up my business in January or February. How do I now file my returns? Because I would have missed out on the other December part, where I'm supposed to file my provisional returns. Now, end of June, I'm supposed to file returns. How does URA treat me in such a situation?
Thank you again for this question. The tax system is configured in a way that if you get a tin in January or in May or even like on 28th June, it means in that financial year you were in existence. I want to make that point clear. That even if you get a tin 2 days to the end of the financial year, that period you are in existence. So if you are to file a provisional return, you are filing for the 2 days. If you start from January to June, again you are filing for only 6 months, and there won't be any penalty that you didn't file in December because you were not in existence. The challenge comes in when you register in October and in December you keep quiet. Then it means you have
I registered in October, I opened up in January.
You know, getting a tin, it means you have become a tax person, a taxable person. So if you have become a taxable person, the only way URA can know that you are not working is through a return. You keeping quiet, and because you are organizing capital and you want to start operating in June, when you registered in October, the taxman expects you to be in business because you applied for a tax identification number. If you are not ready, possibly there is no need of you telling the taxman that I want to be on your register. Because by getting a tax identification number, you are telling the taxman, I'm ready, put me on your register, and I start paying taxes. Otherwise, if you are not yet ready, don't go there. Don't bother them. Yes. Not looking at a register that is having 5 million when you find actually people who are paying taxes is just 1 million.
Well, as we wind up, give us your closing remarks out of this, and maybe re-emphasize, because the deadline is almost as soon. It's a few days to go, and we wouldn't want to see our viewer being penalized because of failure. I mean, late filing.
Okay, thank you. What I can say, URA is doing well in data mining. They can do a 360 degrees check on the affairs of a certain taxpayer. So, if you are preparing to file your returns by June, ensure start with third-party information. If there are those people you supplied and they deducted withholding tax, that's the starting point. Make sure all that information is on your fingertips. If you did any imports, when you are importing, bringing things into the country, already URA has this record. So you cannot leave that aside. Those who are registered for value-added tax, whatever they do is on IFRIS, a record that is kept by URA. So look at IFRIS, look at withholding tax, look at your imports, look at your local purchases, so that you ensure that whichever source of transaction that you have is actually catered for. I said here last time that your expense is another person's income. So the moment you ensure that all your financial transactions have been put in place, you have reconciled, you look at your bank statement, whatever that came in, you can explain, whatever that went out, you can explain, then you are good to go. You file your return, your provisional return will actually be 90% close, as I'm saying, and you will be at peace. Short of that, then you be ready for war.
And war is not a desirable thing. So do the right thing at the right time. Thank you so much for watching us. Wow, it's been an insightful episode as well. We want to appreciate you who started with us up to now. Edrine Mukalazi is my name. I've worked with Jonah Jal and Muhumaza. From the entire team, we wish you a blessed night.
Family Hour, empowering families one episode at a time. Together, we build strong, healthy, and thriving families with our daily dose of inspiration and expert insights on topics that matter, like